that I'm sure many of you could not read. So what I did, and this is just for one time only, I posted a summary of my lecture. This should also give you an idea as to how you need to put it all together. I give you examples and everything in between. I try to define all of the important terms, but at the end of the day, hopefully, I'm able to put it all together. And what I try to do every class day is recap what we covered on the previous day. So this essentially is my recap. Okay. So let me read off from this Word file as well as explain, what we covered. So I said that finance is about managing funds to create value. Okay, this is what we call a business finance class or a corporate finance class, or some people call it a financial management class. So in this class, our goal is to create value for our firm, our business. Could be your business, you could be an employee of a large firm or a small firm. So your job is to create value, okay? So I think I tried to explain to you as to what we mean by value creation, okay? So instead of going back to explaining that phrase or that concept, in an abstract term, let me use these three examples from the first slide to explain to you as to how we go about value creation when we work for a corporation, okay? So for example, how do we create value? By identifying good investments, okay? What is a good investment? And I believe a good investment, a good project is one that promises a higher rate of return than what is required based on the project's risk. I believe I gave you a similar definition. Okay, so your job is to identify good projects and make investments in those good projects. And what is a good project? A business proposal, a business idea that promises you a higher rate of return than what is required based on that project's risk. Does it make sense? Remember that? Okay. So if you evaluate the risk of your business to be average and say you require a 10% rate of return, and I gave you this rule of thumb, 10% rate of return, but that business promises you a 12%, a 13% rate of return. Now that's a good business. You are creating value because 10% will be acceptable, but you're able to produce more than 10%. That's value creation. You all understand what I'm talking about here? Okay, does anyone have any questions on this? Okay, so Facebook is about value creation. So what happens? When value is created, watch what happens to the stock price. Okay, the stock price goes up. Okay, the more value is created, the higher the stock price will go. Okay, because people are watching, people are reading, people are listening to the CEO's, earnings call. Like yesterday, Apple announced its earnings for the previous quarter, and everyone was listening. What's going on? Of course, their iPhones, the sale went down by about 15%. So their iPhones are not doing well, but they are producing better income from services like iTunes, and things of that sort. So they are producing more income from there. So I don't know if I have Apple up there, but the Apple stock price went up by $8, about $7.30, based on that report, based on what the CEO told investors yesterday. So this is value creation. Okay, so you want to do good things for your company, make good investment decisions. Go to China if you have to. Go to Taiwan, if you can lower the cost of business, which is what these companies are doing. Okay, so China is a big deal for Apple. I was reading this morning, their sales in China are in excess of $12 billion. So that's how much China is important for Apple. More than that's how much they sell in China. More than $12 billion. That's a lot of money. Right? So this is value creation. Go where you have to go. And the only thing that you're guided by, of course, I'm not talking about doing anything immoral or unethical, but the only thing that you're guided by is, assuming you are being an ethical person as a CEO, are you creating value? Are you investing in businesses that promise a higher rate of return than what is required based on the risk, of those businesses? Okay, number two, another decision that these business CEOs make is how to finance your operations. Facebook wants to expand. Where is the money gonna come from? Okay, so remember, a business has two main sources of funds. I should be using the word funds. Two main sources of funds. One is borrowing, they can borrow, and the other is raising funds from shareholders, owners. Shareholders are owners. Okay, so those are the two main sources. So the mix that you come up with is very important. The mix of debt and equity, very important. Okay, why? Because we are talking about a trade-off here, and here I think I use the same numbers I used last time, but it doesn't matter as long as the example is clear to you. So there is one big benefit when a corporation borrows money, and the benefit is interest expense is tax deductible. Okay, so let's go over this example which I put on the board. So here, assuming interest expense is not tax deductible. So I said this is your EBIT. Remember, EBIT is earnings before interest and taxes. Okay, so it's $100 interest expense because the IRS says, hey, it's not deductible, so forget about it. Don't put anything there. Okay, so not tax deductible. So all of this is taxable income, $100, and then taxes at 21%. The percent symbol is missing, so this is $21. 21% of this is 21. Income, remember, I can't call it net income. This is just income. Okay, no. Net income means income available to shareholders. Okay, that's what net income is. So this is 79. Now, after you have paid your taxes, you subtract interest expense. Okay, the 20. How much? I'm assuming it's $20, just a given number. And then so 79 minus 20. This gives you $59 net income available to shareholders. You all see what I'm talking about?